Hard to believe we are nearly 1 month in to the year 2023, so we only thought it might be appropriate to talk about some of the investment themes that are already emerging for this year. So we'll talk about that. Plus, last week, the IRS opened up its connectivity to receive your 2022 tax return. Are you ready? We got some tips and some things that you may want to be thinking about before you hit that button for submitting your tax return to the IRS. Welcome to the program. This course is Dollars and Cents, where we help you make sense out of all of life's many decisions when it comes to your finances. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of which are certified financial fiduciaries that stand ready to help you improve your life with a successful and cost-effective financial plan. Why don't you give the team a call this coming week? Maybe we can improve your life on a personal basis. So 1 month in, and certainly the start to the year from a market perspective, well, not quite 1 month in. I guess we got a couple more days to completely close out January, but certainly the markets broadly have had a decent start to the year. Maybe while you weren't looking, maybe while you might have still been in shock over your 2022 annual statement. The reality is that so far, S&P 500 up about 6% since January the 1st, NASDAQ up about 11%. So certainly a good start to the year, particularly on the heels of such a terrible year last year. Now, the reality is we all know that 1 month does not make a year, but certainly the current trend, I think, underscores this growing belief, and hopefully it's a belief that's based upon what actually is going to happen, but this growing belief that, in fact, the Federal Reserve probably getting to the end of its rate increasing cycle. How close are we to the end in terms of when they will stop raising rates? Well, I think that's the million-dollar question, so to speak, but clearly they are slowing down their pace. And I think the market, to a large extent, hence sort of that positive movement in the market so far here in the month of January, is sort of anticipating that point where not only will they be raising in much smaller increments, but even perhaps stopping and letting some of these rate increases, and we've already talked about this in prior programs, letting some of these rate increases sort of come into the soup, if you will. They don't come in instantaneously. They come in gradually in terms of their impact. So certainly something to continue to watch in terms of this market's view or maybe expectation that the Federal Reserve is slowing down. Also, what's underscoring the markets right now, of course, is that we are in the midst of earnings season. So earnings season typically follows after the end of the quarter, usually 3 or 4 weeks after the end of the quarter. You have big companies, well, and small companies as well, announcing their earnings for the prior quarter. More importantly, though, and I think this is one of the things that everybody's sort of listening to, is these companies, when they announce their earnings for the past quarter, they're talking also about what they sort of see or what they sort of expect here for the year 2023. And so consequently, you see a lot of that information sort of coming in to the market right now. If you look at earnings season, there's a total company worth, companies that make up a combined nearly $21 trillion of market capitalization are going to report their quarterly earnings results between the 2-week period that started last week, January 23rd, running all the way to this Friday. So we are sort of smack dab in that 2-week window where you've got major corporations, Apple, Microsoft, and a host of others. I mean, $21 trillion of market capitalization represented by the companies that are going to announce their earnings between last week and this coming week. So we're sort of smack dab, sort of in the middle of all of that. Earnings season has some pluses and minuses, right? You get to see sort of what's cooking, if you will, in terms of the performance. You get to hear about what might be on the road ahead, but also understand that earnings season typically has a lot of volatility for the individual companies as they report their earnings. An interesting statistic, if you look at the last 20 years, the average U.S. stock has seen a one-day price change of either up or down almost 6% on the first trading day following its quarterly earnings release. So that's a tremendous amount of volatility, all sort of surrounding or concentrated on that single day after its earnings release. To put it into comparison, that's more than 7 times the average daily change for companies that make up the S&P 500 over that same time period. So clearly earnings season, very, very important. Certainly tells us what happened, helps to set the road for the road ahead, and also comes with it, though, unfortunately, some level of volatility. So be aware that that is in front of us in the week ahead. So buckle up for the week ahead, as we might say. Remember, here's the key piece. At the end of the day, an individual week or an individual month or an individual year isn't incredibly material in the grand scheme of things from an investment perspective. Why? Because the reality is that you accumulate money over a 30-year period of time, saving it diligently each and every month, right? That's how you're supposed to do it. The reality is also that you wind up spending it over an equally long period of time. So you're talking start to finish like a 60-year swing, like from your time you're 20 to you're 80. That's a full market cycle. That's actually multiple full market cycles. And those are the things to remember, particularly as an investor, that longer term perspective. Here's another interesting stat I saw, speaking of January and how we're coming to a close. And this one kind of struck me. So there was a survey done last year, and this survey found that 35% of Americans, that's over 1 in 3, took part in dry January. So for those of you who don't know what dry January is, it is when folks say, hey, first month of the year, I am not consuming any alcohol whatsoever, completely cut out of their diets. And so what struck me on that number was 2 things. Number one, that seems kind of high, but I guess it's a survey that says, hey, I'm going to do it. And then I wonder how many actually get through it. Certainly I, in the past, have tried to do that. The reality is that it becomes harder to do that if you go out and entertain and all those kinds of things on a regular basis. The interesting stat is it may actually be good for your pocketbook. No surprise there. Average American now spending roughly $900 on alcohol. So if you cut that out for a month, you'll get the equivalent of like 22 gallons of gas, 16 gallons of milk, or like 5 months on Netflix. Some interesting stats. We're going to take a break. When we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So tax season kicked off last week. The folks at the IRS started accepting your 2022 tax return starting last Monday, January the 23rd. We've got some tips and some things that you may want to think about. Certainly if you're a regular listener to the program, we had, I think for 2 or maybe 3 shows in a row, fellow certified financial fiduciary and also certified financial planner and also CPA, Kristen Cayley, a valuable member of the team at Nelson Financial Planning, join us to talk about some of the biggest tax changes for last year and this year. Certainly they managed to jam a lot into that budget bill that passed. at the last week of the year 2022. And so much to talk about, much to chew on. We encourage you to subscribe to our podcast platform stations, whether that's on Apple or YouTube or Spotify or Amazon, whatever the case may be. We have a channel on all of those platforms. If you have any troubles finding us or subscribing to us, go to our website, which is Nelson Financial Planning, and look in the upper right-hand corner, and you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get instantly connected to our program or our channel on those platforms. Make sure you subscribe so you know when we upload new content. But certainly have had some pretty in-depth conversations. We thought in this segment, though, we would just kind of give you just a quick overview of some of the things that are already sort of percolating up, if you will, as we commence the 2022 tax return season. First thing is the deadline, and this seems like it happens like every year. The deadline is not, once again, the deadline is not April 15th. It's April 18th, because usually there's a holiday, or maybe sometimes it's Easter, or whatever the case may be. This time it's because of Emancipation Day holiday in the District of Columbia, which then gives everyone an extra day to file your taxes. And then as the calendar falls, you got the Saturday to Sunday, the holiday out of D.C., which is the Monday, makes the deadline on April 18th of this year. The good folks at the IRS expecting 168 million plus or minus returns. Certainly, that is a tremendous amount of returns. If you live in certain parts of California, Georgia, or Alabama, federally declared disaster areas, you actually have until May the 15th. Next up on the thoughts of the start of the 2022 tax season, we would caution you, and I understand that there's a natural desire, particularly if you're getting a refund, totally understandable, but we would caution you to maybe not pull the trigger too quickly on your taxes. Two reasons. Number one, a lot of the tax forms really aren't due to be out by January 31. That's this coming week. So if you were anxious and wanting to pull the trigger last week, you may not actually have all of your tax forms. So we encourage you to just kind of give it a few extra days. Make sure that you've got everything in. You certainly don't want some unexpected tax form coming in, because it's a real kind of pain to amend your tax return. So try not to rush on it. Give it a little bit more time. Make sure you've got all of those tax forms in. And then the other thing, and I'm sure this is going to be true this year, is there are many tax forms that are not finalized. Look, the reality is when you make changes to the tax code in the last week of the year, it's kind of hard to implement them all within the short period of time before tax returns actually wind up being due. So what that means is that many forms have not been finalized, and you may find that you're not using the final version of a particular form. So again, another reason to just maybe wait it out a little bit to see that you make sure that you've got all your tax forms, and to make sure that you're using the most recent tax document or tax form, if you will, that is in fact finalized before you file the return. Next up is sort of be aware of the bad news, and this may actually counsel you to not rush into filing the return. The reality is it's widely expected that refunds this year are going to be down dramatically over the course of the past 2 years. Why? Well, all of the COVID stuff that was percolating around over the past couple of years doesn't really exist anymore, right? No stimulus checks, no expanded child tax credits, no expanded dependent care credits, and then, of course, no charitable deduction as well. Although that one never really amounted to a whole lot, but at the end of the day, it still was an ability to write off a charitable deduction, regardless of whether you itemized or not. So a great option for standard deduction filers, which nowadays make up over 90% of all tax returns that are getting filed out there. So a great opportunity for those folks to be able to say, hey, we've got an opportunity to write off some amount on our charity. Although for a single person, it was only $300. A married couple, it was $600. So at the end of the day, it might have made $100, $200 on the tax return. But still, that one, again, gone, if you will. Similarly, on the EV tax credits, right? Heard a lot about those. That was all part of the August bill. I think that was weirdly titled the Inflation Reduction Act. And so that one's the $7,500 tax credit for an electric vehicle. Be aware, and we talked about this on a prior program when we were joined by one of our team members, Kristen Cayley, who happens to be a CPA as well. There's some limitations on that. If you bought it before August 16th, you don't qualify. That's number one. And then number two is that final assembly rule, where it's got to be the final assembly has to be in North America. 1099 income, you would typically get a tax document if you have a business on something like eBay or Etsy, or maybe if you're exchanging cash or money through one of the cash apps. Those are now, well, actually were going to be required to generate out tax documents showing the gross amount of the dollars that flowed. Fortunately, that in fact was extended 1 year, but the reality is it's coming. So yes, you got a little bit of a reprieve, and that's good, but to the extent you have a business that's on Etsy or on eBay or whatever the case may be, you probably want to start to use that 2022 tax return as sort of the beginning of laying the foundation of what this business is all about. More often than not, by the time you kind of add up the costs, it's usually going to be at a negative. Well, a negative actually will help you on your tax return, because that means that might go to help offset other income, and it might ultimately wind up being reducing your the amount that you owe on your tax return. So certainly something to think about on that 1099. Kind of dodge the bullet in terms of you must deal with it, but certainly it's coming, so you might as well just kind of start to deal with it and start to prepare. And then lastly, I guess, and this is always the case, don't bother to call the IRS. Backlog still hovering around about 6 million unprocessed tax returns. They did hire an extra 5,000 people to work their customer service line, but you and I both know that there's still going to be a tremendous wait time on when you call the IRS. So just be aware of those little tidbits, especially as it relates to tax season for the year 2022. Already sort of kicked off, if you will, meaning you can file the return, but I might suggest that you kind of hold off on that. Speaking of things that people aren't holding off on, though, last week, or maybe it was 2 or 3 weeks ago, I lose track of time on the program, we were talking about the fact that there's so much money sitting in large financial institutions, sitting in those savings accounts, that at the end of the day is missing out on any amount of interest. Because what the large financial institutions are doing is they're not really raising those interest rates. So interestingly, on the quarterly earnings call for Bank of America, the CEO noted that there was, just in Bank of America, $560 billion in consumer deposits that were in low or no interest-bearing checking accounts, average yield of about 0.06%. That's a pretty low number. So might want to check that out. We certainly talked about that on a prior program. Try and get a little bit more interest, given that interest rates are much higher out there. We're going to take a break and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Almost a full month into the year 2023. Hard to believe that, right? Today is January the 29th. There's a couple more days left in January, and then we're 1/12 of the way into 2023. We thought in the back half of the program we might think about or share some of the investment themes that are starting to sort of take place for the year. So welcome into the program. This, of course, is Dollars and Cents. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks that stand ready this week to help you change your life with a successful and cost-effective financial plan. So many of the themes, as you might well imagine, in 2023 are sort of carrying forward from 2022, right? I mean, that kind of makes sense. This battle, as we've described it for many, many months now here on the program, between interest rates and inflation, the trend, lower inflation, potentially leading to interest rates that maybe don't rise quite as quickly as we saw during the course of 2022. We were talking earlier in the program about the market so far seeming to follow that belief that perhaps those interest rate increases won't be as dramatic or as rapid as what we saw during the course of last year. Time, of course, will tell on that. Certainly the Federal Reserve hasn't made any grand announcement about what it plans to do, but a tremendous amount of speculation that perhaps the interest rates are where they need to be because have seen in some of the inflation data where some of the inflation data is starting to shift down. Certainly from June's 9.1% to the most recent reading at 6.5 for inflation. Yeah, that's certainly better. Similarly, and this was certainly a trend that developed last year that we think carries over into this year, the notion of value versus growth. If you're an investor, you know that there's a difference between value and growth. Growth companies' tendency to describe those as more technology companies, companies that where the expectation is more about what their future might be, versus a value company, generally thought of as a dividend-paying company. Those companies, a little bit more established business model. Think about, kind of more your Johnson & Johnson or companies that pay a regular dividend on a regular basis. Last year was perhaps the largest outperformance of that value over growth in, I think, about 15 years or something like that. So certainly the growth or the tech stuff certainly took a back seat, and the dividend orientation, those dividend-paying companies wound up sort of being more of the leaders, if you will. So certainly some things to consider. Importantly, though, as we talked about a couple weeks on the program, don't necessarily throw out all the growth stuff, throw out all the tech stuff, because the reality is there's tremendous amounts of opportunities when you think about cloud computing, all of the infrastructure that's needed to accomplish that, and healthcare that ultimately will continue to be massive areas of growth. But surely some more unique themes, if you will, are starting to emerge that are unique to 2023. So we thought we would kind of share some of the thoughts on that. Keep in mind, here's the caveat, in terms of your overall investment mix, your overall portfolio allocation, you always want to kind of take a step back and look at it from an overall perspective. Beyond just kind of, okay, I've got X in stocks, Y in bonds, and Z in cash. The reality is you want to drill down, and we've certainly talked about this many times over the years on the program. You want to drill down a little bit and know the types of companies that you own. Are they large companies? Are they small? Are they in the healthcare sector? Or are they in the energy sector? Same thing on the bond side. Are they issued by government? Are they issued by corporations? Are they issued by municipalities? Is the duration short? Are they shorter term bonds, or are they longer term bonds? But certainly important to always understand and look at that overall mix. On this segment, we're talking specifically about sort of some areas that it might be interesting to drill down a little bit and take a little bit closer look at what's going on in those areas. And to start that list, we'd have to start the list off with bonds. Much like growth companies, as we were saying earlier, might not necessarily want to throw out all of those bonds. Certainly no question, bonds did terrible last year, probably the single worst year for bonds, and certainly a bit of an anomaly, if you will. Typically, stocks and bonds trend oppositely, right? When stocks go up, bonds kind of stay stable or go down maybe a little bit. When stocks go down, bonds are usually there to kind of pick up the pieces, if you will. The problem is that last year was the first time in the past 45 years where both stocks and bonds declined and declined relatively dramatically. So it is rare. So we would urge people to not, if you've got bonds in the portfolio, don't start throwing the bonds out the window. Just as we would say, if you have stuff that's more on the growth side, tech side, hopefully you rebalanced prior to last year, and you should be doing that on a regular basis. The reality is you certainly wouldn't start to throw that stuff out at that point in time. Be patient on those bonds, because history suggests that bonds, much like stocks, do recover after a decline. If you look at the 6 prior rate cycles, if you invested in bonds at or close to the end of those tightening cycles, you were certainly rewarded. So much like stocks, bonds recover. And so that's certainly a concept that we're seeing beginning to play out during the course of the year, where you're seeing some of these bonds and bond funds start to show some positive overall results since the beginning of the year. We think that trend probably will continue because they're not raising rates as quickly and as dramatically as they did last year. Otherwise, that would really kill the economy. So as that pace of those increases slows down, then you should also correspondingly see some recovery on the bond side of things. Next up on the theme list, if you will, is dividends. Well, that's probably not a new one. That's probably an oldie but a goodie, but certainly bears repeating, because dividends, and we've said this before many times on the program, what people forget is just how much your overall return as an investor is actually attributable to dividends. If you go back all the way back to 1926, dividends, in fact, account for about 40% of the actual return, of the actual cumulative return that you receive by being an investor over time. And so that's an important piece of the equation. One of the reasons why we don't really like these insurance products or annuity products that are sort of quote unquote tied to the market, the reality is they strip out dividends. Well, if you're doing that, then you're eliminating 40% of the return. So that doesn't seem like a good deal. In particular, if you look at periods of time where you have higher rates of inflation, those dividends really matter. If you think back to the 1970s, which is obviously an inflationary period of time, dividends accounted for almost 70% of the return in the course of that decade. Similarly, in the 2000s, it was about the only positive return because of the 2008 financial decline. So those are just some of the themes that we would encourage you to be thinking about that are probably going to be predominant for this year, 2023. We've got a few more on our list as well. So when we return, we're going to continue this conversation about some of the investing themes to be aware of for the year 2023 here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're continuing the conversation in the back half here about some of the investment themes that we see developing for 2023. Certainly some of the carry forward from 2022 in terms of thinking about value versus growth, dividend-paying companies versus tech companies. Those types of themes are very prevalent and carrying over from the year 2022. And certainly the battle between interest rates and inflation and those kinds of things. But in the last segment, we sort of identified a couple of others that are more particular to 2023. First and foremost, of course, speaking of those bonds, last year, terrible year, but like stocks, bonds do recovery, certainly based upon when you look at prior historical rate cycles. So typically you would see some improvement on that, as is always the case. Make sure that you're well balanced. Don't start throwing out stuff that just had a bad year, because when you look at it historically, it's an important part of any investment portfolio. Similarly, and this is probably an oldie but a goodie, having a dividend orientation in some portion, maybe even a larger portion of your portfolio these days makes sense, as it always has, considering that dividends make up nearly 40% of the long-term return of the market going all the way back to 1926. Their value particularly important during inflationary periods of time. So we've got some other themes to be thinking about here in this segment. So welcome back to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you haven't subscribed to us yet, you should. That way, when you know that we have uploaded new content, you will get a notice that says, hey, we've uploaded new content from our friends at Nelson Financial Planning. So if you have any trouble finding our channels on any of those favorite platforms, go to our website, Nelson Financial Planning. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and voila, you will get immediately connected to our channel. My name is Joel Garris, certified financial fiduciary and certified financial planner at Nelson Financial Planning. So thinking about some of the themes for the year 2023, got to throw healthcare into the mix, right, on that. This may very well be the next tech sector. Much like technology and those types of companies were driving a tremendous amount of the performance of the market over really the prior decade, prior to 2022, there's certainly some contention that the folks in the pharmaceutical and healthcare industry may very well be the leaders going forward. The development of various pharmaceuticals certainly got accelerated during the course of COVID. I think was one of the areas where COVID had that impact of sort of accelerating things forward. Things that were sort of on track to happen wound up occurring within a much shorter period of time. The world certainly needs its drugs. There's also a sad side effect, or I guess a sad comment on society as a whole. The reality is that by the year 2030, it is estimated that over 1 billion people worldwide will be obese. That's a tremendous amount. If you're doing the math, that's about 17% of the population. With obesity comes bad things like heart disease, diabetes, kidney stuff, that kind of thing. Well, guess what? Your favorite industry, healthcare, pharmaceutical, might very well be there to help all of those people out. That seems weird to say that might be a growth area, but that's the reality of it. So some interesting stats on that. Speaking of less than exciting areas or sectors to be thinking about for the year 2023, how about some good old-fashioned capital spending, manufacturing, broadband, roads, power grid, machinery, all of that kind of stuff. And the reasons there are obvious. After years of globalization, there's a trend to sort of return some of that back to home base here in the good old US of A. The reality is that, we've probably got a bunch of roads that we need to improve on, got a power grid we need to improve on, internet connectivity and speed, manufacturing plants. A lot of that is in disrepair or has been neglected or just hasn't happened. Certainly, if you kind of look at some of these rolling power issues, that would certainly suggest that. An area that certainly spending money on, especially when we think about demand for electricity, and not just the electric cars, right? If you've bought any new appliance or anything even fans these days, they all have Bluetooth connections. They all have a power demand. As we talk about, this concept of the Internet of Things, where everything is connected from the fan to the cooktop. I still haven't figured out why my cooktop is connected to like Bluetooth and the internet, because I wouldn't go outside and leave my stove on, but I guess maybe you can if you're connected to your phone. I don't know how that. Anyway, the reality is that is the very essence of the Internet of Things, whereby everything is connected. Well, guess what happens when you connect to something? It takes more power, and it takes a broader spectrum of the internet to be able to do that. So certainly some interesting things that are afoot there. And then lastly, if we think about this, the weaker dollar actually has some correlation as well. Last year, we saw that dollar relative to other currencies. Now, when we say weaker dollar, stronger dollar, it doesn't really have anything to do with whether the U.S. is in good shape or bad. It simply looks at the relative value of the dollar to other currencies. When the dollar is strong, that means the dollar is more valuable. When it becomes weaker, then it becomes less valuable relative to other currencies. Here's how that relates to your money, and here's how that relates to how businesses perform. So when we look at the amount of businesses that generally have revenue from overseas, what you'll find is that the average company on the S&P 500 generates a little over 50% of its total revenue overseas. So that means that when you have a little bit weaker dollar, that usually allows these companies to translate those international sales at a little bit stronger number as you're converting them back to the dollars. Here's some interesting stats to consider. After trading at a 20-plus year high back at the end of September, the U.S. dollar index has declined by about 10% through last week. Since 1980, it is just the sixth time where the U.S. dollar index has declined 10% or more from a 5-year high. In the prior five 10% plus declines, the S&P 500's median performance over the next year was a gain of over 19% with positive returns occurring all 5 times. So some interesting sort of development there in terms of the strength of the dollar, and the dollar just being a little bit weaker, 10% off of its prior high back in September, could very well spell improved earnings for many companies. So certainly a theme to keep an eye out for the year 2023. We encourage our listening audience to make sure that they're thinking about them. Also, taking the time to really kind of drill down into that portfolio mix, that portfolio allocation, to make sure that you sort of have an understanding of what sectors that you own in the course of your portfolio. Certainly, that is something that we do at Nelson Financial Planning with all of our clients, kind of give it that full X-ray analysis, if you will. And that's about all for this week's program here on Dollars and Cents. If you like what you heard or want to learn more about how our team at Nelson Financial Planning might be able to help you, give us a call at 407-629-6477 or visit our website, nelsonfinancialplanning.com.